My name is George Sardakis. I am an associate at Vincent Hirsch Financial Services. Today, as we record this, we're actually quickly approaching the end of 2025, the end of the calendar year, and we're actually going to walk through a few items that we address with our clients on their year-end meeting checklist. And this is in no particular order, and if you have any questions, please consult with your financial advisor, your financial professional, tax advisor, etc. First on the list is going to be a required minimum distribution, which is a distribution that is required to be taken from any pre-tax retirement accounts, such as an IRA or a 401k. It's a mandatory withdrawal from these pre-tax accounts by the IRS in order for them to finally collect on these tax-deferred funds. Missing R&Ds may result in penalties, and we usually coordinate with other professionals such as the client's accountants with regards to the tax implications that would be associated with taking these withdrawals. Roth conversions are another item that we save towards the end of the year, and this is because we have a better picture of what the client's tax situation is at the end of the year rather than in the beginning or at the middle of a particular year. So, for example, as we near December, we understand that the client's adjusted gross income might be X. Whereas in July, we don't know if, for example, if a client is also paid on bonuses and commissions, we don't really have an idea as to what that number is going to be, or if they're taking withdrawals, additional withdrawals from any pre-tax accounts. We don't know what that number is going to be necessarily for the calendar year when we're in, say, June or July. And essentially what we're looking to accomplish with a Roth conversion is we're looking to take the pre-tax money from a traditional IRA. We're going to pay the taxes on it, and it's going to go into a Roth IRA where it's going to grow tax deferred and then later withdrawn tax-free in retirement, provided that the account has been established and the funds have been settled in the account for 5 years. And we typically coordinate this, again, with the client's tax professionals just because we want to have an understanding as to what the implications may be when it comes to, say, Medicare or the client's income tax bracket. Capital loss harvesting is another item that we address, and essentially what a capital loss harvesting strategy is, it's a strategy wherein we look to collect losses on any taxable accounts. This would be after-tax, non-retirement accounts throughout the year that could then be applied to any capital gains that the client has realized over the course of and we kind of have a better idea as to what, again, that tax situation is going to be as financial planners and as professionals, which can then be used towards the client's taxable events for that year. As we move towards the end of the year, we look to address HSA contributions and FSA spending. We're going to address each of those separately. So an HSA, which is a health savings account, we look to address the contributions for these accounts because they offer a triple tax advantage for a client. They offer a tax-deductible contribution where we reduce the client's taxable income for the year as the money gets deferred into the account. The money then continues to grow tax-deferred, and then finally, when we use them for eligible health expenses, the funds can be withdrawn from the account tax. So we want to be able to address this, again, in conjunction with the client's tax professionals and understand what the potential tax benefit would be if a client were to make additional contributions to their HSA accounts before the end of the calendar year. Whereas with an FSA, we are on a use it or lose it schedule. So we want to make sure that the client is taking advantage of any FSA flexible spend accounts prior to the end of the year because this balance does not roll over. So if a client has $10,000 remaining in their FSA accounts, that's not going to transfer over into the next calendar year. So we want to make sure that they're able to see any doctors last minute that they can, or if they've been putting off any kind of minor surgery, they can use these accounts. For those clients who are charitably inclined, we look to address their charitable giving strategies and their plan at the end of the year as well. This falls in line with a couple of different reasons. The first being, if the client is required to start taking R&Ds and they don't necessarily need the income and they are in a position where they could use the tax benefit, they are actually able to take what's called a qualified charitable distribution, or a QCD, and take the R&D and donate it to a qualifying 501c3 or charitable organization. And we do this with the clients to, again, at the end of the year, to understand what their tax situation is. And being that they have to take the R&Ds already anyway, we kind of use to help reduce their taxable income, and in conjunction with taking their R&Ds. We can also maximize our charitable strategies by utilizing appreciated securities and donating them as well to 501c3s or non-profit organizations, and help to get that tax benefit for the year as well. Finally on our list, we have 401k, 403b, employer benefit contributions. So if we have a client who is able to, we can contribute more to their 401k, 403b pre-tax to be able to take advantage of that max and also take advantage of the tax benefit. Now, they can also make the contribution into Roth if that's what they so choose. Again, as long as they're able to afford to make that additional contribution from their paycheck. Now, these are just a few things that we do touch on with our clients here at Vincent Hirsch Financial, and some of the checklist items that are addressed in our year-end planning meetings. I hope this was helpful, and we look forward to sharing more information with you in the coming episodes. Thank you so much.